Major funding for this program has been provided by grants from Bank of America, Merrill Lynch, and Perfect Building Maintenance, New York Community Bank, All Nation Renovation, KILROY Architectural Windows, New York's Window Company, Greenberg Traurig, LLP. Additional funding has been provided by grants from AVR Realty Company, LLC, Briarwood Organization, Capital One Bank, C.B. Richard Ellis, Cushman & Wakefield, Dime Savings Bank of Williamsburg, Eastern Consolidated, Douglaston Development, Hal Fettner, Durst Fettner Residential, Stephen Napolitano, First American Title Insurance Company, Friedman, LLP, Gemini Real Estate Advisors, LLC, Genova, Burns and Gian Tomasi, Grubb and Ellis, Investors Savings Bank, Jack Jaffa and Associates Real Estate Consultants, James D. KUHN Real Estate Institute at Syracuse University, Madison Realty Capital, Markham, LLP, Marcus and Millichap Real Estate Investment Services, Margolin Weiner and Evans, LLP, Massey Knackle Realty Services, M&T Bank, Meridian Capital Group, The Moynihan Group, Newmark Knight Frank, Orphanides and Associates, Siami Development, Inc., SJP Properties, Sterling and Sterling, Inc., RAL Companies and Affiliates, LLC, Spandrel Property Services, Urban American.
So here we are in 2011, and my shiny apple says maybe it's going to be a good year, maybe it's going to be a tough year. But I really want to know what the leaders in the banking community think 2011 is going to be like. So today I've brought together 4 top-notch bankers to provide their input on how they see 2011. My guests they include Vincent Pellegrino, the chairman and CEO of the Dime Savings Bank of Williamsburg, Stephen Rosenberg, the chairman and CEO of the Greystone Company and also chairman and CEO of Greystone Bank, John T. Adams, first senior vice president at the New York Community Bank, and last never and least, my dear friend Gino Martocci, the president of the New York and Long Island region of M&T Bank. So Gino, how is the apple going to be shined? You know, is it going to be straight up, or as John T. said, is it going to be on top of my head and be with a bow and arrow?
I think there's a couple of things. One, we're seeing transaction volumes approaching sort of 2006 levels. I mean, there's a lot of activity out there. There's fewer players for certain products, and so as a result, we're fortunately seeing a lot of activity. 2011, I think interest rates are going to remain low. New York City and Washington, the market seems to be continuing to recover and across product types. And so we're pretty hopeful about 2011. I think the certainty around the tax issues and the payroll tax cut is beneficial. I think perhaps 2011 will be better than 2010.
You know, I think that's a really interesting thing, Vinny. You know, if you talk about, you know, a lot of people were trying to sell. I was at a holiday party and people said, oh, I had to close my loan because the capital gains. So now 2011, you don't have that capital gains question over there. You have a couple of things are sorted out. Do you think that's going to change people's thoughts of buying real estate or financing real estate?
I think the market is just generally improving. It's a very slow process. It's been almost 2 years now, and New York has been peculiar to the rest of the country. We've been kind of isolated from the other problems they've had around the country. I think we had a very good year this year. We're looking to a little bit better next year, but I really have had no complaints for the last 18 months or so. Non-performing loans have maintained well within reason for us. We're doing as much loan volume as we can handle. We can increase it more, but I don't want to concentrate too much at the levels we are now with the interest rate. There's always that interest rate risk hanging out there. We all know sooner or later rates are going to go up. It may not be this year, it may not even be 2011.
But you know, Vinny, you bring out an interesting point. You know, and I don't want to age us, but you know, in the late 80s, early 90s, we hit a 20% prime. And the situation is, we've been in an artificial number for the last couple years at a very low interest rate. What happens 3 years down the road that interest rates, the rate on the 10-year now is in the low threes, it's a 5 or a 5.5. How does somebody come to you and refinance a loan?
Well, the loans that we've been making, especially in the last year, it's been very conservative. Typical LTVs have been running probably between 50–60% of value. We're doing modest amounts of these loans, but that's going to carry us forward. So I don't think there's a problem. The other thing that I think we're always considering is the rent regulations here in New York City. It's a peculiar situation in that, number one, it stops values from going up too fast because they can't decontrol them. But the reverse of that is it provides a very, very low vacancy rate. On rent-stabilized apartments, there's probably 0 to 1% vacancy. So there's never going to be a question of turnover. It's a very stable situation, and you're almost guaranteed to get rate increases every year.
Now, Stephen, you have a little different thing because Greystone lends throughout the country, so you see things in a different market. How do you look at that in your perspective, with Fannie Mae and FHA and just in general because of your banking exposure? How do you look at?
Well, at this point, we're seeing FHA volumes quadrupling compared to prior years. The fact that for the last few years, the securitization market has not existed has certainly contributed to that volume. And as well as there are definitely markets in the country that no other lenders other than FHA is going near. So Arizona, Midwest, even Detroit. Now, obviously, every loan has to be underwritten, but they'll still lend in that market. It's interesting because you talk about the risk of interest rates rising from the perspective of the bankers and the lenders. What we're finding now is that the borrowers themselves are trying to take advantage of these historically low interest rates and are looking for that 3 3/4% or 4% 35-year self-amortizing loan. And we had never seen that type of volume before, especially from the New York area, or those types of requests. New York, in particular, is extremely well covered by the local banks, and the banks do a great job. But we're seeing now requests on the part of borrowers and brokers for loans that have that 35-year, very low interest rate, self-amortizing aspect.
John, what are you seeing?
Well, I kind of mirror the responses that you've heard so far. We're going to see 2011 as being one of the better years that we've seen the past 09 and 010, and maybe even the latter part of 08. I'm seeing robust volume. We're seeing a lot of applications coming in for not only refinances, but not even with our own portfolio, but refinancing out others from their portfolios, but a lot of sales transactions. Not only in the multifamily, but we're seeing a lot of sales on the CRE, the true commercial real estate deals. In addition to that, I'm hearing that there is offers are going out on multifamilies where someone's entering into a contract on a rent-regulated building, and offers are coming in to flip the contract for $400,000 or $500,000 more than what they've entered into contract for. So you hear that going on, and I don't see 06, 07, because I think most of us learned that cash flow is where it's at. You can only underwrite to cash flow, but the premium that people are starting to pay because they have some cash in their pocket, that's starting to really come about again.
But I think that really comes out. I was with someone yesterday from Michigan, not Detroit, and he said he's been in the business in that market for years, and he was coming to me asking my advice and raising some capital and this and that, and he said that the deal was a deal in Arizona, in Texas, and the transaction, they were going to give like an 8% return on that. And you go to the bank, I know you give a nice number on your deposit, especially if I opened up in the new Cedarhurst branch, but you were giving, but your rate is...
Might get 1 1/4.
I might get 1 1/4. But the point is, when somebody says you can get an 8% return, people look at it. And if you can get an apartment house in Manhattan at a 5% return, people are looking at it. Now, you've done deals with some, you have probably the creme de la creme, just like you, but more in the commercial real estate area with people who have, made a commitment and they're looking at it in the future. You're underwriting it in a conservative basis, but with Kaufman and other people, their thoughts of New York.
Well, I guess more generally, our view is we're getting better sponsorship with more equity at better spreads than we ever got 3-4 years ago. So we want to take advantage of that while we're relatively healthy. And so you are seeing, particularly in multifamily space though, 11 times the gross, 10 times the gross, people are willing to pay this. It seems to us like a lot of money. We're seeing sub-5 cap rates on some trades, and I understand it. It's rate driven, really.
Right? But you're also seeing, because I think you financed last year, a couple of office buildings and you're underwriting it based on the actual cash flow, not giving the future cash flow.
We never gave any consideration.
But there are people, at the beginning of the year, when the Harbor Group bought 4 New York Plaza for $97 a square foot, it was unbelievable. Now, in December, Harbor Group just bought 1412 Broadway for like $386 a square foot. But buildings like 1330 Avenue Americas is selling for $765 a square foot. And, people are thinking that the rents are going to go up, but fortunately, all 4 underwriters here aren't writing in that number. But there's a zeal, there's an enthusiasm in the market.
I think it's 2 things. I think it's heavily rate dependent, and a lot of equity was raised, and they couldn't put it to work. Now they're putting it to work, and they're getting very low rates locked up for 3 to 10 years, and they're able to make the numbers work in that way. That's something you have to be very cautious about.
So here is the situation. In 2011, do we see banks, do we see government agencies, do we see situations that people are going to start lending again on construction financing for multifamily and other properties? Vinny?
I think there's a backlog, though, of projects that have been just sitting dormant, although I am starting to see some improvement in that area. A lot of the buildings that have been sitting there for 6 months or a year, all of a sudden you see activity going on again. So I think that product has to disappear first before you're going to see any new lending.
But if you lend in January or March of 2011, the product isn't really going to come to the market for at least 18 months.
That's true.
Or longer.
Or longer. You've recently lent money on multifamily.
Again, given the amount of equity that's going into deals and the sponsorship we're able to do the deals with, their financial commitment in form of guarantees, we're happy to do deals. We're willing to do deals that are construction deals today, conservatively
including
underwritten.
For condominiums.
Yes, we're even doing some condominium inventory loans at $350, $400 a foot for stuff that's selling at $1,400, $1,500. Recent contracts. We're comfortable doing that.
No question.
The thing is with the condominiums, of course, you have this buildings that were all built as condominiums, and they're now being utilized as rentals to a great extent. So that's another part of the absorption problem, I think. You're going to have to wait for those units to be converted back to condominiums and then have those sell out.
What we're seeing is new build in good locations is absorbing pretty nicely. Yeah. It's the tertiary locations where you have the problems.
We see a tremendous amount of building in Williamsburg along the waterfront.
Yeah, that's tougher.
Going from the Williamsburg Bridge, I guess, all the way north up to Newtown Creek. And you got the largest developers going over there. Toll Brothers are building there. And there's still quite a bit of vacancy and quite a bit of temporary rental housing that's in those buildings.
But you see rents have gone, they're over $50 in some of those buildings now.
I'm amazed they get the rents.
They're getting them.
But what they're doing is you got 3 and 4 people sharing. And that's the way they can afford the rentals. Right. And again, it's a temporary situation. Condos will recover, and they will sell those units off.
But, we were talking before, and one of the reasons, I wanted to make sure that Stephen was on the show, is that there is, there's FHA money available for new construction. And in New York, It hadn't happened. There was FHA money maybe 25 years ago, and a lot of these buildings, which were Mitchell-Lama or others, were financed by FHA. So now you see in 2011 FHA returning to the New York market for construction?
Yeah, I don't think there's any doubt about it. We've had record numbers of requests for FHA construction loan financing. I think everyone would agree that there is no more aggressive lender for new construction than the FHA. They go up to close to 90% loan to cost, and it's a 40-year self-amortizing, very low interest rate loan. So the end product is a great loan to have on a building. And FHA recently has changed some of their guidelines and regulations to make it easier for borrowers. So right now, FHA will consider a property that where there has already been work done on the land, and they'll lend to properties or do construction loans on projects that already have their foundations in place.
Is it geared towards affordable?
No.
This is open market? Free
Yes.
market?
It used to also be that FHA never worked in New York because there were certain regulatorily imposed statutory limits on the amounts of money that could be loaned per unit. FHA just changed that, and they said that on top of the statutory limit, they'll also add the value of the underlying land. And so properties that otherwise wouldn't qualify for FHA now do qualify for FHA.
Now, something that, I had spoken to some people about the FHA as an alternative, and then the comment that was given to me by a very successful developer was Bacon Davis, with wages. Now, many of the developers that Gino does business with, the construction developers, they use union labor. But when they hear of Bacon Davis, what is Bacon Davis to me?
Well, again, the Davis-Bacon requirement is that you use union labor. And for the most part, what we have seen is that on some very small properties that would otherwise maybe not use union labor, so the additional cost to use the union could be 25, 30%. However, on the larger properties, I think most of the borrowers would otherwise have used union anyway.
They do,
and we're not really seeing that they're impacted by that.
John, construction loans, 2011.
That's a very slow walk that we had spoke about earlier when we were getting ready to come on, that if we're going to look at a construction loan, most likely today it's going to be on a piece of property that where maybe have a development site. That's a performing loan. However, the intent on our end was just to facilitate them acquiring the property, and then at a future date when they had their plans and permits, and would be taken out with another construction lender. Though we do have a construction portfolio, we do monitor it. It's for the most part performing. A couple of deals that are struggling a little bit, but for the most part, we've been pretty solid. So we want to maintain that. So we're not looking to run into doing much more by way of new construction. However, if a deal gets presented before us, good sponsorship guarantees, it's definitely something that we would take a look at. We were talking before about the market being sparked by way of construction, and you had mentioned 18, 24 months before property will be delivered. We're also seeing, excellence in 2011. I have a deal now where someone's looking to acquire the site for a future construction loan, not taken out by us, but to assume the loan. They're buying the property at $300 a square foot. It's here, it's in Manhattan, it's in the Chelsea area. But a year and a half ago, you probably couldn't have sold that for $125, $150.
No, the land prices, when I look at shows that I've done in the past, if I discuss somebody trying to sell a piece of land in Brooklyn in 2009, as I would say in my articles, do not pass go, do not collect $200, and do not talk to me. Today, land is trading at a much higher price because people who are wealthy or can hold it will want to keep it in their portfolio, and then when the time is right, they'll develop. But the $300 is a rather high number. Now, we were talking about, and M&T has done very well with some very strong sponsors with regard to the hospitality market. Hospitality market has improved around the nation, and it's really improved in New York. Do you see And there are new hotels being built. Do you see M&T continuing to finance the construction of new hotels?
Very selectively. For people we have a great track record with, lots of equity, well located, we'll do them. But you know, you got to be careful with hotels. Fortunately, we always have been careful with hotels. And when things got overheated and people were providing 75 and 80% financing based on, you know, and sort of projecting 10% a year increases in ADRs, we pulled back, and fortunately, and now's a good time to look at it again. John?
We've never been a hospitality lender, only again, reason being it's really not a market that we've been really exposed to a lot. We're plenty busy with the multifamily and some CRE deals, so I don't see us really, you know, looking for any hotel construction loans, at least at this stage.
Stephen, any of the government agencies get involved with financing of the hospitality industry?
No, no. That's an area you don't have to worry about competition from any federal agency.
Nothing.
Now, retail, you know, in certain markets is improving. How do you look at retail today?
We typically do more of the strip center type of lending in well-established neighborhoods, long-term tenants, the 10 stores with a couple of mom and pops thrown
So
in.
you don't. So you're not really dependent on it being a grocery anchored
No, not
retail.
At all. Grocery, drugstore, none of that. Majority of ours do not have that. We may have one or two, but that's not our typical
What's your
product.
smallest loan that you'll look at it?
200, 300 grand.
You really? And your
Of
largest
course, we get a much larger.
premium? No
premium
question.
on the rate.
Risk reward, and your
Largest one, we probably have a couple up in the mid-20s, 20 millions. That's probably unusual for us, though. I think I said our average loan is about $1.5 million to $2 million. So that's our sweet spot.
Gina?
We're sort of agnostic as it relates to loan size. I mean, so sort of $1 million would be the smallest, and over $100 million would be the largest.
And the $100 million you'll keep on your own books. You don't have to.
Well, we syndicate some of it.
Right.
We'll underwrite it, though.
And you?
Yeah, we're probably in the $1 million range. Will we do less? Yeah, for a relationship, somewhat less. We could maybe do a $200,000, $300,000. It's not common, but it's something that we'd look at. Yeah, we'll do 100. We'll do 100. You know, more than 100 for the right deal, right sponsorship. But our average loan size probably $4 to $5 million. You know, we like the $10 to $15 million range as well.
Stephen, what's FHA, Fannie Mae? What's the sizes?
Well, loan sizes, you know, start as low as $1 million or less, and go over, you know, can be a few $100 million. So there's really no limitations either on the low end or the high end. With respect to retail, the only retail that we focus on would be retail that is part of a multifamily complex.
And that can't be more than 20% of the total gross income.
Right. That's right. Both agencies, HUD as well as Fannie Mae, are pretty much at that 20% level.
And that's retail, and let's say if it was a garage, that would also include the garage. So anything that's not commercial
That's right.
for the residential in this situation.
That's right.
Garages, any thoughts?
Yeah, we like them. Garages are good businesses. You have to pick the right operators, and they're good locations, and they're not making too many more of them.
You know, I'm not sure who brought it up. It may have been Stephen. One of you brought up the term, and then you and I always have the same opinion, of the securitization market. The securitization market created, they were there, they were needed, but they were also the devil who created major problems, because the underwriter said, if I throw it in the box, I don't worry about it. Securitization has returned in 2010. It'll get stronger in 2011. What effect do you see that having on your lending? Because you still have to make loans when the little animals are out there making loans.
Look, right now the market's in need of liquidity, so it's, I think, generally a positive thing that they're back. The underwriting standards have not gotten out of hand like as they did earlier in the decade. We'll have to keep an eye on that, but right now the market's sorely in need of the liquidity, so I think it's a good thing they're back.
Stephen?
Well, I certainly agree that that the conduits and securitizations are coming back, but I agree with Gino that the levels at which they're at the moment are still relatively conservative, and that's why on the multifamily side you're not really seeing much activity at all on securitization, because the government agencies are able to make more aggressive loans at better terms, and so are some of the local banks.
You know, it's interesting. There was a report that came out of RCA, Real Capital Analytics, about the insurance companies, who, as we know, have always been very conservative, and they've been a major player, and they've been a major player even in the multifamily market this year.
They just took us out of a large commercial real estate deal. We got paid a handsome prepayment penalty, but it was principal. They came in at a unbelievable 10-year fixed rate that we couldn't compete with.
And you couldn't compete with.
We wouldn't. We're not really a 10-year money guy. But for the right deal, we would look at doing a 10-year deal. But for the spread that they were getting, we loved it.
But I do believe that the insurance companies, I mean, there was an article, I wrote it, about Met had done close to $1.9 billion for the first 9 months of the year. I mean, a really large number. And Met, perhaps the prior year, did about $900 million. And Met, Prudential, you have a lot of these guys who have money out there, and they need to do this. So they may become major competition again in the market.
Where else are they?
Say probably more so than the securitization market, because they tend to be better underwriters, more realistic, more cash flow driven than the securitization market. So I agree.
It comes down to where else are they going to get the yield? They've got to find yield somewhere, and they're not finding it until recently they weren't finding it in the equities market, and certainly not in the bond market.
I think what we're seeing on the insurance company side is they're not going to compete by driving up the loan amounts.
Proceeds aren't going to be
proceeds,
crazy. Right?
That's their hard stop. But they can do pretty much whatever they need to do on the interest rates.
Right.
I think also on the term, I think they prefer a longer-term product.
Right.
They don't want to be involved with a 5-year product. They have different goals for what they want to do with the money.
So, you know, if I had to look at my shiny apple, the apple seems to be shiny. And, you know, as we sit here at the beginning of 2011, it looks like all signs are positive over here. And hopefully later on in the season, I'll have you all back and we'll see where our thoughts continue on. I'd like to thank Vinny Palagiano, Stephen Rosenberg, John T. Adams, and Gino Martocci. See you next week.
Major funding for this program has been provided by grants from Bank of America, Merrill Lynch, and Perfect Building Maintenance, New York Community Bank, All Nation Renovation, KILROY Architectural Windows, New York's Window Company, Greenberg Traurig, LLP. Additional funding has been provided by grants from AVR Realty Company, LLC, Briarwood Organization, Capital One Bank, C.B. Richard Ellis, Cushman & Wakefield, Dime Savings Bank of Williamsburg, Eastern Consolidated, Douglaston Development, Hal Fettner, Durst Fettner Residential, Stephen Napolitano, First American Title Insurance Company, Friedman, LLP, Gemini Real Estate Advisors, LLC, Genova, Burns and Gian Tomasi, Grubb and Ellis, Investors Savings Bank, Jack Joffa and Associates Real Estate Consultants, James D. KUHN Real Estate Institute at Syracuse University, Madison Realty Capital, Markham, LLP, Marcus and Millichap Real Estate Investment Services, Margolin Weiner and Evans, LLP, Massey Knackle Realty Services, M&T Bank, Meridian Capital Group, The Moynihan Group, Newmark Knight Frank, Orphanides and Associates, Siami Development, Inc., SJP Properties, Sterling and Sterling, Inc., RAL Companies and Affiliates, LLC, Spandrel Property Services, Urban American.